I will be explaining a concept that I find a lot of traders don't really understand from the outset. I mean, you can possibly trade without knowing it, or without being 100%, I can say, aware of its implications, but it does add a bit of an edge to your trading if you do. Okay, so the time is 6:58, so we'll just start a bit earlier. Everyone else can just catch the recording. Now, firstly, I want to talk just a bit about leverage. Okay, it does seem like there's still a bit of confusion regarding what leverage actually is, and how it affects how many lots you can trade, and as a result, it can cause a bit of issues or problems when it comes to people being margined out. So to avoid all of that, we'll just focus on that for the majority of tonight's session. So let's just make an example now. $10, $100 rather, is how much you deposit into your trading account. Now, what leverage basically means, right? The leverage is a ratio that the broker will apply to your trading account as soon as you make a deposit. So like a good faith deposit of some sort. But as soon as you deposit funds into your account, they apply the leverage that you picked, right? So leverage can range from 1:30, 1:2, to up to 1:1,000. I think I've seen 1:1,500. Okay. Now, what that basically means is that out of each and every single dollar that you have in your trading account, your broker will then give you that amount for you. Let's say you pick 1:100. Okay. On a 1:100. Okay. On a 1:100, for every single dollar that you have in your trading account, your broker will provide to you $100. So essentially, you're going to have your $100 multiplied by this $100 that for each and every single dollar that the broker gives you. So if the leverage that you apply is 1:200, so let's just say you go out with a leverage of 1:200 and you still have the same deposit minimum, and now you apply 1:200. That basically means for each and every single $1 in your trading account, the broker will then give you $200 for each one of those dollars. So that is $100 multiplied by $200. Okay. Now, the purpose of this is for you to be able to trade and control a bit more of the market, you can say, buy a bit more contracts, become more financially savvy. But it's in essence a way to help traders be able to trade a bit more. And from the example that I'm going to give in terms of amount of units you can purchase and you can sell, and how much it technically costs, you'll see why that is important information. Okay. All right. So that doesn't work. So let's just stick with this as our example. Now, on your account, you're only going to see the $100, right? So on your account, you will only see $100. You won't see 1:200 on all of that. But technically, okay, you have, okay, it just changes everything. All right. I think red is fine. So technically, you have $20,000 in your trading account. Right now, your balance that you'll see in your account is $100, but technically, with leverage that the broker provides, right, you now have $20,000 for you to be able to trade with. Now, this is very important because once you understand the amount of units you can buy or sell when it comes to the market, then you'll understand why, if you only had $100 in your trading account without any leverage, you can't even place one single trade. You can't buy a single micro, you can't do anything. So basically what the leverage allows us to do is to control a bit more of the market. So in terms of contract sizing, right? So some of us call them lot sizes or contract sizes, but basically that's a certain amount of units that you buy or you sell of that particular currency. Okay, so let's say I want to buy one standard contract on the euro dollar at current market price, let's say 124.25. That basically means I am long. I'm going to buy 100,000 units of the euro. Okay, so the equivalent of 100,000 euros. So standard contract is 100,000 units. Okay, so a standard contract is 100,000 units, and it is represented on the MT4 platform as 100. Okay, let's do this. Okay. Now next up, we have a lot size which is a bit smaller than your standard contract. So if you don't have enough funds in your trading account to trade a standard contract, then you might trade a mini contract. Now a mini contract is basically 10,000 units of that particular currency. So if you're trading the euro, you are buying 10,000 euros. Okay. If you are trading the GBP, then you are buying 10,000 units of the GBP. Okay. Right. So, and then our last or smallest lot size is basically what we call the micro. Okay. Now the micro is 1,000 units. So in the example of the euro, buying euro USD at 0.01, you are buying 1,000 units of the euro. Now that is represented on the MT4 platform by 0.01. Okay. So standard contract, 100,000 units, mini contract, 10,000 units, and a micro contract would be 1,000 units. Okay. Now keep this information in mind, because when actually sort of like figuring out how much we would need to place the minimum trade, this information will be important. So let's say we use that $100, which now technically, right, technically is 20,000 US dollars with leverage. Okay. So if I wanted to purchase a standard contract, which is 100,000 units, using a $20,000 account, okay, that would not be possible. Using a mini contract, yes, I would be able to buy 2 mini contracts. Okay. Micro level, right, I would be able to buy, I think, 20 micro lots. So you'd have trades, 20 trades of 0.01 in terms of lot size, and about 2 trades that are at 0.10 each, and 0 trades at 1 standard contract. So if you try to place a standard contract with this size account, with this size leverage, then the broker will probably return not enough money to have that. It obviously means you can't trade above, or you can't trade that particular lot size. You need to choose a lot size a bit smaller than that. Okay. Okay, makes sense. So trading that 100 US dollars, okay, which is now obviously 20,000. We don't see that as 20,000, but what we do see is the $100 in our trading account. And now it allows us to place a bit more trades. Now there comes limitations with leverage, right? Now leverage is a double-edged sword. Obviously, something that helps you, because the broker gives you this loan and they don't expect you to pay it back. But the profits that you make with the loan, you can keep, which is very odd for a broker. But I mean, it's something that's leverage has been around for ages, and it allows you to increase the amount of profit that you can actually potentially make. Okay, so even on a bigger size account that could handle 1,000 units or 10,000 units, you'd want to apply leverage in order to take advantage of the profitability that's available there, right? But as I said, it's a double-edged sword. If you don't know what you're doing, it can drain your account very quickly as well. So when we take a look at margin, right? So margin is, simply put, how much you need to have in your trading account. Okay. Now, a margin percentage would mean, let's say your broker's margin percentage is at 50%, right? That might be high, but yeah. Now, this means that your total losses, okay, your total losses should not exceed 50%. So your total open trades should not exceed 50%. So it's sort of like an, I don't know, a minimum deposit, an available amount, right? So the minimum required to keep a certain bank account open, and if the funds are depleted or it goes below that minimum balance, then the bank will send you an SMS and say, okay, now you've gone below a level where we are comfortable with you being, so you need to add money into your account. So it basically follows the same sort of sequence, but now what happens is, if you have, let's just say $100, right? Okay, so let's just say $100, because I'm pretty certain if you have traded live before, right, you'll see your free margin. Okay, there's the free margin, and there's the margin, and there's the margin level. So actually a percentage. Now, the margin is the amount that's actually tied up, right? So when you place a trade, out of $100, okay, each amount that you place or each trade that you take ties up funds. It's sort of like when you swipe something at the using your bank card, right? So if you have a check account, for example, then it'll go to pending, right? So you had 1,000 Rand in your account, and then you swipe $100, right? You'll have 900 left technically, but let's say the funds haven't left your account yet, right? They're still tied up. You can't use that amount. So that's what margin essentially is. Okay. And then the stopout percentage in terms of margin is the percent that the broker closes your orders if you exceed it. Okay. So let's just say one trade would be, I don't know, $10. All right. So each and every time you place a trade at 0.01, it ties up $10. Now, since $10 is tied up, you only have $90 available in your trading account to work with, right? Until you close this trade. And when you close this trade, right, then you add that that $10 back into your account, right? It becomes free or available again. You can trade with it again. Now you also see free margin. Now below that $90 would be the free margin, right? And the $10 would be the margin. That's the margin that's tied up. That's the amount you can't use. But the free margin is the amount that you can use, right? That's the amount that you can still trade off with. And it's very important to always look at that number. You must always look at that free margin number, because sometimes I do believe that everyone gets a bit wild, and they try to do some very crazy things and start placing, I don't know, 10, 20, 30 trades on one currency pair. So if that's the case, right, your margin drops down to, or your free margin rather drops down to zero, you can't place any more trades. All right. So it means once your free margin, your account might still be at $100, but once your free margin, let's say, is $1, and the minimum you need to place the lowest lot size, which is a micro at 0.01. Let's just say it's $10, right? So now your margin that you have tied up in trades is $99, but the free margin that's available for you to trade with is only $1. So when you try to place another trade, it's going to say not enough money. Okay, so that's where you get that error, not enough money returned from the MT4 platform, because you can't exceed the amount of margin that you actually have in your account, right? So make sure, I mean, not to worry too much about the margin, but worry a lot about the free margin, because that tells you if you are basically over trading, right? Typically, you want to keep it above 50, right? Or half of your account. So if you have $100 account, that would be $50. If you have $1,000 account, that would be $500 US, and even that is a bit, hectic. Okay. So as I said, that will be free margin, and that is the margin. Margin just basically means the amount that's tied up. You can't use that amount. So and this would be obviously your balance. Okay. Now the equity, let's just say, I don't know, the trades that you are running have $1 profit. Okay. So you might see difference between equity and balance, right? When you have trades open. So when you have trades closed and if you flat out the market, your equity and the balance should reflect the same amount. But the equity is basically the balance plus minus any trading wins or losses. So if you're making some profits, it will be reflected in equity until you close it, right? So those are all the open trades. That's the open flow. So if you have a balance of $100, but your equity is at $200, that means you have $100 in profit yet for you to be realized. You haven't closed the trades, they're still open. Okay, but as soon as you open, or you close them rather, then the balance and the equity both say $200. Okay, now I spoke about margins, stop out level, and that is something that also comes from the broker, because you have to remember they need to sort of protect what they have invested, what they have invested in you, which is obviously the loan. So they require they have certain percentage when it comes to margin stop out. So let's just say you have $100. Okay. Now your $100 goes down to $49. Okay. Now if your trading account has a 50%, or if the broker applies a 50% stop out level on your trading account, that means if your trading losses, right, exceed 50%, which is in this case $50, they then apply what we call a margin call. So if your account, let's say, is, okay, let's just squeeze that in here. So if your account is $100 and the stop out level is 50%, this basically means that your trading losses at any given time open should not exceed $50. Okay. Right. So 49 is okay. So the losses might mount and say 49, 48, how the market moves, 46, and then all the way back up to 49, and then it says 50. Okay, now what they do now is the MT4 platform will start flashing red, indicating that you probably about to get margined out, And the word basically comes from, or the term comes from back in the days when people were trading on the pits and stuff like that. So you'd actually physically get a call from your broker saying, okay, right now your trade's actually losing money in the stock market. So you need to put in some more money. Otherwise, you're going to have to close all your losing trades. Right now, on the MT4 platform, it does it for you automatically. I think it also sends you a message, like some kind of those emails, but it actually lets you know you are exceeding that margin percentage stop out level, and therefore just closes all the losing trades, all open trades basically. And then if you still have anything left after that, right, then they'll apply that same 50% to whatever's left in the account. So let's say you have $50 now left in the account. Now your margin stop out level, so your stop out level will now be $25, okay, because we're still at 50%, okay, but now it will be 25 US dollars. Okay. And if those trading losses also exceed, I think 1250, then the same thing will happen until your account is too small to even place a trade. So that is essentially how things work when it comes to the market. And just making sure that the admin part of the business is not neglected, because a lot of people don't understand this, and for good reason too, because this is not the most exciting part. A lot of people just want to know, okay, candlestick patterns. They just want to know where to enter, where to fix it. So I think that's one of the major issues why a lot of people are not aware about what margin call is, the difference between margin, free margin, balanced equity, leverage. So hopefully you've been following tonight's session. And if you do have any questions, now would be the best time to ask them.